Please pay attention. If you want to have buy-sell signals with the highest probability, you need to take positions that are in the same direction with the current trend of the market. In this video, I want to introduce a trend indicator that helps you to effectively find trading opportunities within a trend. I'm going to teach you a trading strategy based on this indicator mixed with price action trading, so make sure you watch this video until the end and let's get started. Before I add the indicator, I'm proud to announce that recently I published a book, The Art of Price Action Trading. The link is in the description and you can get it later if you're interested to learn price action trading and take your trading to the next level. Alright, to add the indicator to our chart, here we click on indicators and we search range filtered trend signals. This one, which is written by Algo Alpha. Alright, this is the indicator and as you can see it's overlaid on the price chart. This indicator is a combination of Kalman filtering and super trend, and because of also considering volatility, it's able to help us with trending and non-trending situations in the market. First, we go to the settings of the indicator to make it optimized. We go to inputs tab and here for Kalman period, we set it at 155. So it will better help us with trend identification. Here we have Kalman alpha, which is for controlling the smoothness of the indicator, and Kalman beta is for controlling sensitivity to trend changes. These settings are okay, but in case if the asset that you're trading is too much volatile like crypto, you can increase them a little bit so the indicator will be smoother and less responsive to the large swings of the price in trading ranges. And here we have deviation, which is set at 1.2, and this is the distance of the bands from the middle line. Similarly, you can increase this depending on the volatility of the market. And here for super trend, we have 0.7 for super trend factor and 7 for ATR period, which are optimized settings for the strategy that I want to explain. Alright, now let's see what we have here and how we can use it for trading. Here in the middle, we have this gray line, which is actually our trend line here, and it acts as support and resistance level. You can clearly see that whenever the price reaches the gray line, we have somehow stopping of the price and then bouncing of the price in case of uptrend, or falling of the price in case of downtrend. So this gray line here, which is our trend line, is acting as support and resistance level, and I'm going to teach you a trading strategy based on this, so make sure you watch this video until the end. Alright, we have also this dashed line, which is the extent of the trend by considering the volatility. Depending on the direction of the market, we have three colors here. In times that the price is moving flat, like here in this part or here in this part, we have two dashed lines and the area is gray. So when we have this situation, it tells us that the price is moving flat. When the price is in an uptrend, the zone between the price and the lines is marked by green color, and when the price is in a downtrend, the zone between the price and the lines is marked with red color. So this indicator is helping us with the identification of three phases in the market: flat market when the indicator is gray, uptrend when the indicator is green, and downtrend when the indicator is red. This indicator also generates signals by the help of these small green and red circles when a new trend is starting in the market. But I don't recommend using them as buy-sell signals for trade entry because many of them can be false signals and not beginning of a new trend. And instead, I recommend using this indicator for trend identification, meaning by the help of this indicator you identify trends and then you try to find trading opportunities within the trend. For example, when the trend is showing uptrend, we try to find long position opportunities in the pullbacks, and when the indicator shows downtrend, we try to find short position opportunities in the pullbacks. Let me show how we can do it. The best strategy to find opportunities in the pullbacks is price action analysis. First of all, when the indicator is like this, I mean the indicator is green, we must look for long position opportunities, and when the indicator is red, we must look for short position opportunities. And in times that the indicator is gray, like here in this part or here in this part, we don't do anything because the price is moving flat and we don't enter any trade in these types of situations. When we get a green circle which shows beginning of an uptrend, and after that the indicator becomes green. In this situation, we start looking for long position opportunities. As I mentioned earlier, in this situation where the price is trending up, this line, this gray line, is acting as a support level. So when the price falls and touches this line, after that it is expected that the price will advance in the direction of the uptrend. But we don't enter a trade here just simply because the price touches the gray line, because this can be beginning of a change in the trend and the price may turn to a downtrend. So we need more confirmation, and we're going to use price action trading. Before the price turned down and went for this gray line, you should identify the last swing high where the price had difficulty to advance more and declined after that. This is a potential resistance level, and when the price turns back to this area, it can find difficulty to pass. In this case, you can see that how many times the price got rejected in this level. You should wait for the price to be closed above this level. When we get a candle closed above this level, we can enter a long position. Here, this candle is closed above this level, but this is a very weak candle and it has a long upper shadow, as you can see. So in practice, we don't enter a trade here by the help of this candle because this candle is not showing buying pressure. And you can see that after that, the price again went down and stopped here around this level. Here at this point, we got a relatively strong candle closed above our potential resistance level. So in practice, we could enter a long position at this point when this new candle was opened. The stop loss for this trade is placed below the previous swing low and profit target at risk to reward ratio of 2. After this trade, you can see that again the price pulled back to the gray line. We mark the last swing high, which is here this level, and this can act as a potential resistance level, and we wait for a candle to be closed above this level. Here you can see that the price reached to this level but then stopped and declined because, as I said, this level is acting as a resistance level. At this point you can see that we got a relatively strong candle that is closed above our potential resistance level. So in practice we could enter a long position at this point with the stop loss below the previous swing low and profit target at risk to reward ratio of 2. And in downtrends, we do the opposite. When we get a red circle, which shows beginning of a downtrend and the indicator becomes red, in this situation, we look for short position opportunities. As I mentioned earlier, when the price is trending down, this gray line here acts as a resistance level. So when the price touches this gray line, after that, it is expected that the price will decline. But we don't enter a trade just because the price touched the gray line. You can have a profitable trade like this one, but it is also possible that the price will continue advancing and passing the lines and turning to an uptrend. So we need more confirmation. We identify the last swing low and we mark it. This is a potential support level, and it is probable that when the price turns back to this area, it will find difficulty to pass. So we wait until the price breaks this line. In this case, you can see that we had a large gap and this candle opened and closed below our level. The gap itself also acts as a resistance level and the price will find difficulty to fill the gap. So here we enter a short position at this point when the new candle is opened. The stop loss for this trade is placed above the previous swing high and profit target at risk to reward ratio of 2. Alright, in the examples that I showed, the market was truly trending after the signal. But what if the market goes to a trading range after the signal, like here in this part of the chart? When the flat movement of the price is small, the indicator becomes gray. But when the price is in a trading range with larger swings of the price, we can have repeatedly signals for starting of a trend, and in this situation we may encounter false signals. Here you can see that we have a signal for starting of a downtrend, then the price pulled back to this gray line. We marked the swing low, but you can see that the price didn't go down and break this level and the indicator became gray, so no false signal here. Again, here the indicator gave the signal for starting of a downtrend. After that, the price pulled back to the gray line. In practice, this is our beginning of the pullback, and so our swing low here, so we mark it. And here you can see that this candle closed below this level, so in practice we would enter a short position at this point, but as you can see, this is a losing trade because the price advanced after that. In this case, we could easily avoid this false signal. First of all, it's better to focus on the pullbacks where the trend is a little bit established, and after that you get a pullback, not just right after the trend signal. And second, we are doing a trend following strategy, so we shouldn't enter any trade when the price is in a trading range. In this part, you can clearly see that the price is in a trading range and moving in a tightening consolidation period. We are not doing a breakout trading strategy, we are doing a trend following strategy. So we shouldn't enter any trade in this situation. By the help of price action analysis, you can easily filter false signals like this where it is happening in a range market. Besides price action analysis, there are some indicators like ADX, this one, average directional index, that can help you to filter false signals during non-trending market. You just need to add a horizontal line here at 20 level because 20 is the benchmark in this indicator. When ADX line is above 20, it tells us that the market is trending, so we take the trade like this short position here where the ADX line is above 20. So ADX is confirming this trade, but when ADX line is below 20, it tells us that the market is not trending. So we don't take any trade. In this case here, we could just not taking this trade because ADX line is below 20, as you can see. By the help of ADX line and adding another layer of filtration, you can decrease your risk by rejecting the trades that are happening in range market. But you may also lose some potentially profitable trades where ADX line doesn't confirm. The most effective way is price action analysis, but regardless of the method, you will never have a trading strategy with 100% win rate. Losing positions are always part of the game, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.